Keith, great to finally get here at Real Vision. We've had so many people trying to introduce us, get us together, and I've always been I've followed you for a long time on Twitter and other things and thinking, this is a guy we need to get on Real Vision. So finally, thank you for coming to join us.
Well, thanks for having me and for making it work. Your studio is far nicer than mine.
Thank you. So look, tell people a little bit about the background of what you do now, and then more importantly, how you came into the business and a little bit of your story.
Yeah, so now I have a company called Hedgeye that's 10 years old, but I started as any other analyst on Wall Street, got a job as a hedge fund analyst, didn't know what I was doing, started to figure that out a little bit. Worked with a guy named John Dawson as he was breaking up with a guy named Art Sandberg, if you probably recall Pequot Capital.
Yeah, and Art's been on Real Vision.
Yeah, oh, okay, cool.
Yeah.
And so we were right there on Pequot Avenue, that's why it's called Pequot, in Southport, Connecticut, and I cut my chops as a buy-side analyst. Then they gave me my own book, probably too early. Back then, we didn't have factor exposures or limits or hedges.
Which year was this?
This is back in I started as an analyst back in 2000.
Right. Okay.
Yeah, graduated from college in '99. As a Canadian, you're about 35 years old at that point. So, so then I rolled into your traditional Wall Street investment banking program. Couldn't stand that after a year and went to the buy side, and then eventually became a portfolio manager. Had my own fund, and sold
you were
it.
running tech portfolio or
consumer, global consumer,
okay, right.
with a big, and that's kind of how I got into global macro. Was I got tired of modeling companies that couldn't tell me what the forward outlook was from a macro perspective, because that's of course what they would always get wrong. So I would get wrong, and I didn't like being wrong. So started to build a global macro overlay to actually analyzing companies from a bottom-up perspective, which was easier with global companies like Nike, for example, or some of the big ones that I started to understand better earlier. But it all started with just being an analyst. I started as an analyst. And now today, I moonlight as a macro strategist, but all my macro calls are born out of that same analytical process. That's 20 years, we're almost 20 years later, but I've really just applied most of my fundamental learnings as a bottom-up analyst to my top-down view. And it's certainly not a qualitative one, it's how I quantify it, like this whole rate of change process that we built and whatnot. But
so that process of bottoms up and top down was kind of the tiger management approach. People like that, some people have done it really well because there's a lot of top-down information in the granular data, in the bottoms-up stuff, if you know what I mean. And a lot of people don't look at it that way. So is that what you did? You kind of try to marry the two together?
Yeah, I mean, in the beginning, again, you always start with you don't know what you're doing when you're trying to refine, a better path of getting it more accurate more often. And I just fundamentally couldn't understand why people weren't applying like a process, a repeatable process from a macro perspective to signal what is the dollar impact going to be, again, to use example, what is the dollar impact going to be on Nike's quarter? What is the global growth rate decelerating going to do to Nike's European business? So that's, it was just a logical conclusion that you should get to having a rate of change macro process as an overlay to bottom-up companies. Then I started working with many more bottom-up analysts. I let them do that, because that's a full-time job. I mean, there's plenty of hedge funds today that believe that's all you have to do. And it's been a great learning experience starting to see what everybody else does, like being in the other team's dressing room, so to speak. Because now I'm the sell-side guy, or whatever you want to call me, and I get to learn what they're doing and try to help them augment their process with mine. And it's been a great voyage in that regard. You learn so much faster when you see what other people are doing, and you can back test it. And because my goal, of course, is to be right, and I have no problem boring other people's best practices. There's plenty of them out there.
Yeah. So one of the things I found that was my epiphany moment was back in the late 90s, where I suddenly realized if you look at the chart of GDP, it goes up and down. It's cyclical. And when you look at every single analyst, they assume linear demand, let's call it. So in which case they don't ever look at the macro, is how will the global demand situation driven by the business cycle change the performance of Nike or the dollar or interest rates that companies borrow at or anything. And I had the same epiphany. It's like, really? I mean, this is really 80% of all returns come out of macro.
Yeah, particularly at the turns. I mean,
at the turns especially.
So I like to just think of it as one gigantic sine curve that can have the amplitude and longevity of anything. There's no fixed point.
Correct.
But people who are modeling things bottom up don't quite like that. They want it to be linear. So that's the opportunity, is really in understanding and having, I like to think that if you have an apolitical and data-driven view, you can really be data dependent. You know, the answer's staring you right there in the face. And a lot of people, when they do macro, they do it one of many ways now. Obviously, there are many different strategies, but the big difference I see is a lot of people say this is what the data should look like or could look like, or the outlook could or should look like. Whereas we've built plenty of mathematical tools that are more modern than anything you might have seen before in terms of macro hedge fund managers and whatnot. Predictive tracking algorithms. You can know day to day. It's not a guess anymore. You can now cast what the market is telling you about what is right there. So trade what's in front of you as opposed to what you might ordinarily want to see. And I think that was a great learning. I mean, as opposed to certainly trying to tell the macro market what to do, just listen to it. And again,
a lot of people do try and tell it what to do.
Yeah,
so it's not doing the right thing. It's like, well, maybe either you're too early or wrong.
Yeah. I mean, I think most of what I do is a function of all my mistakes. I mean, I've tried.
Anybody who says you can't approach this business without humility, because I always say every time you think your shit smells of roses, you're going to get your face rubbed in it, and it's true.
Yeah, it's absolutely true.
You know, it is all about failing. I mean, anybody who doesn't understand that failure, repeated failure, but losing less than you make in the upside is the whole investing game, and learning from why you're failing is the icing on the cake. So once you started figuring this out, what made you leave kind of traditional Wall Street and set up your own shop? Talk me through that whole process.
Well, first I got fired. I mean, that's the best way to start.
Okay, that's a good way to
start. So you start from a real safe place of not being able to go back and do your job.
Yeah.
I was at Carlyle. So as I walked through it briefly, I mean, I had my own hedge fund probably at too early of an age. I effectively went to Magnetar Capital and rolled that into a big book there and started to learn, what are these factor exposures? I mean, Magnetar had this proprietary system that was very early in its days, and I give them a lot of credit for that. And I had no idea what it was that they were doing until I finally lived inside of that. Carlyle asked me to come basically run long short for them. That imploded within what was the fastest loss of capital certainly than I've ever seen. We completely blew up Carlyle's initial hedge fund. And it wasn't me, our credit team lost a significant amount of capital in a short period of time. So effectively...
Was that with Ralph Reynolds and Rick Goldsmith?
Yeah, that was. Yeah.
Because they were my old bosses from years ago.
Oh, they were? Yeah.
At NatWest.
And so I was with them for a very brief period of time. It's kind of a classic, like you said, you think it smelled like roses. When I got hired by Carlyle, I thought this is the best job possible. You're a young partner managing whatever director title at one of the biggest private equity firms on earth that's going to fund their first hedge fund.
It's a no-brainer.
Yeah, and then 6 months later, I'm carrying a box with my notebooks. Yeah. And my son's going to be born the week after that, my first son. So it was a pretty jarring experience. I mean, the number one reason why I started my own firm is that I had a non-compete, so I couldn't go back. And the second reason is that after a couple weeks, I was like, I kind of like not working for anybody but myself. And that's when I started to think through, okay, what is it that I could do that could actually change the world a little bit more than me just having another big P&L.
What year was this?
This was in late 2007.
Right.
Yeah. And I had an explicit market view that was much different than Wall Street's. And that was the beginning of making an early and big bear market call to start. That's effectively what I started the firm with. Was a call that people would be paying attention to, not for the sake of making the call. It was the same process I'd used for the first part of my career and what I was seeing at that point in my career. So I saw a big opportunity in being in print, or as I like to say, time-stamped, with accountability using modern technologies. And don't forget, a lot of the things that came to be over that period of time were new. I used to call it YouTubing the street, or tweeting obviously was shortly thereafter. There are so many ways to communicate why things were happening a certain way, why other people were saying, that's not happening, this can't be happening, this should not be happening. All the way down, obviously, to Warren Buffett in October of 2008.
Yeah. One of the reasons, and we'll go into this a little bit later, but one of the reasons we started Real Vision was for exactly these reasons. That there is no such thing as the truth, but there's somewhere closer to the reality and somewhere that's non-reality. Yeah. And we just looked at what was going on in the media business and what was going on in Wall Street and thought, this is not reality and it's not fair. People forget it's people's life savings. And the bullshit that they get fed so often it's just not fair on people. So that, I think we were all driven by the same realization that we had to do something about it. We almost had. I always felt like we always had a bit of a moral obligation to do something about changing how the system was.
Yeah, I agree with that 100%.
And even, the part you walked into was, in terms of the research business, the independent research business, there's a load of great independent researchers, but then there's this behemoth that makes $1 billion a year, which I won't mention their name, out of newsletters, built on sensationalism and starting newsletters and burning them and all of this kind of stuff. And again, not really caring about the individual. And I saw what you guys done. I thought, okay, this is good because somebody's actually doing this properly, trying to build a proper business out of it, but using kind of modern techniques of doing it and not just the old way.
Yeah, I mean, and back to your point on there are different ways that people express their edge in the market. There are different processes.
Yeah.
But God forbid you have your own, and you've built it and you refine it and you evolve it and you learn from its mistakes, its failures. It's always evolving and changing. So what I've realized pretty quickly, I'm very comfortable being transparent and accountable to what it is that I'm doing and what I thought something should have done, when it's right, when it's wrong. It was the perfect forum for me. And that not only was it fun, but you could change the world doing that. Because a lot of people can learn from you. Don't forget that there are a lot of people, like Hedgeye, the whole concept was to put some transparency. If you could look inside, if we could look inside of this conversation, would I want to hear what we're talking about? Of course you would.
And that's why we used real vision. Exactly the same idea.
And people want it to be real.
That's right.
And that's if I could look inside of a world-class hedge fund, not in terms of its reputation, in terms of its process.
Yeah.
Because I still think that there's a huge opportunity there. And looking at hedge fund returns, I'm more convinced today than ever before that is the case. A lot of people have made a lot of excuses over the years of why they can't make money.
Yeah.
And I've not had, God willing, I'm not going to have that problem at the point where I think it's a structural one. If I'm wrong, I'm going to be wrong. But what the real opportunity is in showing people, look here's our process. You tell me why this is wrong. I'll tell you why I'm doing this. I want to vet it at the highest level. 100% of our revenues in the beginning were with who I think are some of the most sophisticated hedge fund managers that had good numbers, that were willing and really having an open mind to listen to what it is that I was thinking and why. And then bringing it to the masses. Because if I can validate it with plenty of names that you've had conversations with out in the open, then I could surely do better than somebody like Jim Cramer. I mean, this is almost like an insult. When you think about it. The bar is so low in the mass market relative to the institutional market, but both are very wide open nets in terms of the educational opportunity. I think that's a big part of when I think of Hedgeye and its media presence. I think that's the most important thing: how to try to educate both our audience and then get the feedback where I get educated where I'm wrong.
Yeah.
If you tell me where I'm wrong and I validate that as a good reason, it's not my job to stay wrong. No. And that's a great thing to have that feedback, both from the mass market audience, rich people that want to be rich, people that do well on their own, or institutional money managers, which there are many of them.
So coming off 2007, 8, you called it brilliantly. You set yourself up into business. So where do you then make the mistake? Because I had a terrible year in 2009 by getting absolutely amazingly right in 2005, 6, 7, 8, and then 9 I got it dead wrong. Where did you then have the dead wrong moment where you realise that even you might have the right process? I'm very process driven myself.
Yeah.
Sometimes you ignore the process, which is a genius thing to do because you always get it wrong when you do, or it was just one of the probabilities that you didn't foresee.
Yeah.
So where did you get it wrong after 2008?
2011, mid to late 2011.
2009
was great. I mean, we went bullish in April of 2009.
Fantastic.
So that's where my wife didn't know, but I go both ways, and that's how I started getting people. Like, wow, I thought you were what? I thought you were the hedge fund guy, and this is where it changed a little
bit. You're going to be bearish, yeah.
But going back to the dark side or back to bearish properly in late 2010, overstaying my welcome through 2011, that's where I made when Bernanke decided to twist the curve and the whatever it takes took over the narrative, I just did not believe that could change the economic gravity back to delta positive.
Yeah.
Because I thought this was it. This was part 2 of the great financial crisis.
Yeah.
And if you go back and read anything that I wrote or anything that, or listen to anything that I said, it's all timestamped. It's all there.
Yeah.
You'd be like, this. I was pig-headed. I was not data-driven to the extent that I am today. So a lot of the mistakes, I like to think that when you make a mistake, it's a big opportunity to make your process better. That was a big one. I mean, if I was running big money back then, that would have been a nasty year for me in the back part of 11. And then finally went bullish in 2012 and stayed bullish through 2013. But I mean, that was easily it.
That period, I think I was relatively lucky with. 2009 was where I just ignored my own process. Because I just thought the smaller probability outcome is going to be the one that happens, which is a dumb thing to do, right? You're betting on the really small probability. But that's what I did, and it screwed it up. So now talk to me. So now you've developed your process. So you've learned from the big mistake 2011. You're now moving forwards. How's your business evolved, and how's your process, more importantly, evolved to maybe to where it is, where it got to in the last couple of years? What is your process now, and how does that look like?
Yeah, the two big components of my process have never been more robust. So I have the fundamental research process, which we call our GIP model, or growth inflation policy model. Effectively, get the rates of change in growth and inflation right, and you're going to get the forward behavior of the policymaker right. If my outlook is in Q4, we said quad 4 in Q4. It's our 4-quadrant model. Quad 4 is when you have growth and inflation slowing at the same time. I said, if that turns out to be accurate and the data continues to rinse and repeat, negative rate of change, growth and inflation, the Fed will not only not be raising interest rates, the last rate hike will be into a slowdown, and then we'll be talking about falling interest rates. So it's a good example of, that's the model that we use. We call it our 4-quadrant model. So you might see, when we say quad 4, hashtag
So it's
quad
a business
4.
cycle model, essentially.
Yes, it's fundamentally in that it's using, like Dalio might, rate of change of growth and inflation as the two most causal factors. For not only asset allocation, but sector exposures, factor exposures. We've got that down now. Like that, I have a roadmap. The process is repeatable. It's literally impossible for me to have style drift relative to that component of the model. So where I have, the most, I guess, opportunities in the signal. So my market signal that I've built over the years, trying, back testing everything that I can. Like some people get upset when I say that they're using moving monkeys. I mean, it's because I used to be a monkey. I am a monkey. I mean, we're all monkeys to some degree. But if a 50-day and a 200-day moving monkey worked, I would use it. So I have a market signal that's basically price, volume, and volatility driven. With volatility being, or the vol of all, as Mandelbrot would have taught anybody who's studied it, is the most important thing to look for. A cluster of volatility that's non-trending that becomes trending. Okay, now that market signal is going to instruct my model. So I know that the market's trying to front run me. That's the best strategist. And that's what those two things are as refined, I think, as they've ever been. They get better with computing power. Both of them. They get better with more people who understand the computing power. We're using advanced Excel, Python. We're not using what I would have used historically. We have predictive tracking algorithms that are getting closer and closer to the numbers. So you're moving towards that, because I was going to ask you that. It sounds like you're moving towards a full algo model, right? Well, you use it to nowcast growth and inflation because they're trivial numbers. They have components and they have dynamic reweightings. So we can do that. You couldn't do that as quickly as you can do it today. And now I'm doing...
But there again, the nowcast numbers aren't particularly consistent, as we've seen between different variations of nowcasting.
Oh yeah. I mean, it's, as Picasso would say, it's not what you're looking at, it's what you see. I mean, if you're looking at the Atlanta Fed nowcast, you're looking at some version of a disaster. I mean,
it was great at first, and then it's been...
And it's great because it's what wasn't there, and it's what people ideally would want. Of course you would want to know.
But why don't they just use ISM?
They'd actually do better with a rate of change model that's one factor driven, which I would never do. But that would be better. Like the intra-quarter tracking error that we have on our nowcast for US GDP is 20 basis points right now. The Atlanta Fed is 240 basis points on a number that can be 300 basis points wide. That's not god-awful. That's beyond that. Like if that is what you're using as an assumption. The value in that, the Atlanta Fed model and the New York Fed model, is that you can fade it. If the street believes that that's where GDP was, which they thought, for example, at the beginning of the fourth quarter, you'd be around 4%. Oh boy. I mean, our number's at 1.54%. So that's where you can really use And I also think the evolution of macro tourism on Wall Street is a huge backboard to play against in that regard.
Yeah, yeah.
You know, if everyone thinks that it could be 3, 4, 5% GDP and you got a 1 in front of your number, well, now we have an opportunity.
Talking macro tourists, I think one of the largest macro tourist position I've seen in a long time was everybody shorting bonds.
Oh boy,
in Q4.
Yeah. Well, you see, there's a lot of treasury issuance. Did you hear about that?
Yeah. Oh, it's all about the issuance. It drives me nuts. Because people.
Oh, and the twin deficits. Did you know?
Yeah.
And Trump. Did you hear about Trump?
No, it surprised me all the way through. You know, and again, my argument. I've just written a piece about this in Global Macro Investor. Is the one thing when I step back and say, why did everybody get that call wrong?
Literally.
So the more interesting thing is why did they get it wrong? Now, even if we both had the same view about where inflation and growth was going, and I gave it to people, and many people would say, but it's not, it's the deficits and everything else. What they forgot to look at was demand. The demand for treasuries was the fact that it was the largest short position in recorded history, all points of the curve, and then the pension system was record underweight, the household sector was record underweight, and still is. The amount of buying of treasuries that can come is in the trillions. So it's almost impossible for them to issue enough treasuries to create a problem. And all you needed was that one bit of kindling, which is a slowing economy, and it started the stampede.
Now they're begging on their knees for more. And they will continue to, until you get the final cowbell. And the market doesn't respond to that. I mean, this is the beginning of that. I mean, any great call in macro starts with exactly what you just said. The street has to be on the other side of you.
Always.
I mean, it was the biggest, to your point, like we measure and map this weekly because it comes out, and CFTC futures and options data comes out weekly, and it was the biggest net short position in the history of 2s, 5s, 10s. And
Eurodollar futures, the whole lot.
And my map, Quad 4, says number one asset allocation pivot is buy that, all of that, across the curve. Okay? That, once in my life, that might happen.
Yeah.
Like, that's cool. But you know what most macro people do? They make that call, and then that's their call for 30 years. You know, it's what we know is that when growth and inflation slow at the same time, bond yields are going down.
So,
because people need treasuries.
So we've got the bond yield. You nailed it. Okay, so as you and I know, macro is, there's a core view, and the bond view probably works for quite a long time further, depending on what your models start saying about whether we're going to go into recession or not. We can guess, but we don't know yet. What's your view on that first?
Yeah, you don't need it. First of all, you don't need a recession to lose half your money. I mean, you know,
in the stock market
or in credit. I mean,
in credit.
Yeah, both. I mean, the two biggest things that happen as you go from what we call Quad 4 to Quad 3. So let's just, for argument's sake, let's just say that the outlook continues to be right.
Yeah.
If the outlook's right, you're going to have more cowbell. You're going to have more Fed easing. The next thing's going to be rate cuts.
Yeah.
What you're going to get is economic stagflation. You're not going to get a real economic growth breakout. We already had that. We had 9 consecutive quarters of year-over-year GDP growth accelerating. That's never happened in the history of the U.S. To get an acceleration, what do you need? Easy comparisons. A recession usually will do it. You can accelerate out of easy comparisons. We not only had easy comparisons coming out of the 2016 slowdown, we had the Chinese stimulate like they never had before, the biggest stimulus in the history of China, as you know. You had the Fed basically easing alongside them as Janet saw the numbers, dot plots falling. And then you get post-Trump election tax reform. Fully loaded, Germany's in the 94th percentile of historical readings on GDP. And everyone thinks that globally synchronized recovery is something that's going to go, you know, rainbows and puppy dogs up into the right forever. I mean, it's the uncomparable comp.
Yeah.
Actually, so the slowdown part is easy. You know, the amount of stagflation you get via Fed easing is not easy. Because that's based on the pace of their awareness.
Do you get stagflation? I mean, see, I don't think that's the case. For my personal opinion, my view is that having traded both the 2000 and the 2007 rate cuts, all I know is what happens is as soon as the more cowbell starts ringing, the equity market goes, oh, isn't this brilliant? And they try and go to new highs and they don't make it.
Yeah.
And then every time the Fed cut again, it's like, oh, it's brilliant. It's going to be okay. Forgetting that it takes like 6 or 8 rate cuts and 18 months before it feeds through. And then everyone goes, oh, shit. And the market then collapses. And then you have to go through the whole thing. And then you bottom out whenever you bottom out.
Yeah.
And so I'm not sure that there is any reflation or any sign of stagflation within that, unemployment's going to stay low because the aging population. You know, you look at the Japanese unemployment rate; it doesn't move as much as it used to.
They're right.
So that's kind of what I'm thinking about this. But what do you think about so? What are equity?
It's a shorter term, and I'm quite precise about this. So when you go from quad 4 to quad 3, all you need literally is 10 basis points of year-over-year inflation. We're not talking about stagflation, 1970 style stagflation. You know, that could happen down the line, but all I'm talking about when you go from one economic scenario, which is right now you have growth, inflation are slowing at the same time.
Yeah.
The Fed's job is to try to arrest that, which arguably they did. I mean, oil down 41%, but then can bounce materially. That's a hybrid reflation in a very short-term period. It doesn't mean that that'll be my call from here until, like, I literally change I have 4 different outcomes, quad 1, 2, 3, and 4. That, when I say stagflation, there's a knife's edge, literally, between stagflation and deflation. Because if the cowbell's not working, to your point.
And you can go move through one into the other.
Bingo. And
now I understand. Your rate of change, you're talking a short-term rate of change as opposed to the full cycle.
Right. And this is where people, you know, rightfully so, think I'm nuts. I mean, because they think I'll change my mind whenever. And that is absolutely true. You know, there is no playbook to say that you should stay in one quadrant for X period of time. That's not linear. No. You know, but there is
and
one.
How long do these quadrants last generally for you?
There's nothing typical about it. I mean, emerging markets, for example. It was in quad 1 or 2 for 8 consecutive quarters. Never happened in the history of emerging markets in the aggregate. That's wonderful because as long as you're in position for quad 1 for the first part of the move, you just stay with it until the data changes. But oh boy, when we went, then that was our call at the beginning of last year, I thought it was a better call than most calls because if you think people were short treasuries as consensus, I mean, long emerging markets and emerging market credit at the beginning of last year was straight up no-no in my model because Q1 of 18 was quad 4. So it's more when you go from quad 1, pro-growth, everything's great, buy pro-cyclical credits, you know, buy the Argentine peso, for God's sakes. People would buy anything at that point. Brazilian credit was a big long trade for the hedge fund community. Then boom, you hit quad 4 very quickly in Argentina, and then you're in a recession 2 quarters later. So it's, parting the heavens and, smoothing the seas is not my job. It's reading, much more like a weather forecaster is what the data is doing against the base effects. If the base effects are steepening and the data is slowing, I'm going to be calling for slow.
So coming out of this quad 4, as you call it, moving into quad 3,
yes.
What is that? That's a rally in equities and a rally in credit?
It's just a rally in the things that got blown up the most in equities.
Okay, right.
Oil and energy are the two number 1 and 2 pivots off the lows.
Is that what we're seeing now, part of that?
Yeah, I think effectively, at some point, that's what we'll see in Q2. If the Fed goes from, no more rate hikes to next move's a cut, it'd be very hard with correlations where they are, 15, 30 day, I'm talking about tight correlations, inverse to the dollar. It'd be very hard for me to not see big moves up and down in oil. But again, you want to not be short that move. We've been bearish on commodities for a long time, and we're at the beginning of the market giving you a peek at that.
What does fixed income do in that?
Well, you want to be long duration. You want to be long. Your portfolio wants to be basically minimum vol, long duration.
But the yield curve should be steepening at this point, right?
Because
when they start cutting, it's steepening, right?
Steepening off its inverted point. That's where I think the Fed will be more aggressive in actually saying we will cut interest rates. But you're only 15, 20 basis points away.
Sure. My thought is the curve inverted if adjusted for low rates? So if you look at Japan, never inverted again.
No, good point.
Europe didn't either, right?
Yeah, you don't
Europe's
have that.
never inverted again and has had 2 recessions since. So maybe it's inverted. It's low regardless.
Right.
So it's kind of the steepening is what I'm kind of thinking about.
Yeah, well, and steepening is easy to get once if 2-year yields go from 250 to 1. I mean that's actually one of my favorite positions, even though it's the most boring thing to most people.
It's the best trade. It's the short end.
It's like, here's one way to not lose your net wealth. Don't have massive drawdowns and take positions that carry well. Like in the case of 2-year bonds, I bought them at 3%. It's time stamped. It's there. Never done it in my life, ever. This was really exciting. People are short treasuries, but that thing can go from 3 to 2 to 1, and you will get your steepening.
I'm short that. I'm long 2 years or short yields, euro dollars, 5 years, 10 years, the whole thing.
Not everybody believes in this, obviously. I mean, this is why it's working.
No, they don't. And certainly not the short end, right?
And then if you look at the long end, like if you have a global macro perspective, it's so much easier to understand the downside. Because equally is equally fervent as the I'm short treasuries because of supply and the U.S. deficit and their political view. Like I'm Canadian. I'm not a Republican or Democrat, and I don't have a political view on that. But if they have it, great. If you have all three, that's where you're going to find your hawks on treasuries. If you look at global yields, I mean, Swiss 10s at minus 23 beeps and German Bund yields at 20 basis points. What is that telling you about slower for longer? I mean, and by the way, what's it also telling you about the relative attractiveness of people that actually have to buy long-dated fixed income securities? They're going to buy treasuries. They're not going to buy Chinese bonds.
No.
Yeah, so
that brings me to the currency question. Where does currency fit in for you? I'm currently neutral. I was very long dollars, been neutral for a while now. I'm personally waiting to get back in long dollars because I'm waiting to see the positioning wash out.
Because people have gone net long dollars. Yeah.
I don't know, what's your view? How does it fit into your model? Because I find currency is the hardest to model. I do think there's the dollar smile, where if things are really good, particularly in the US, the dollar does well. If it's really bad globally, it does well. And the dollar usually gets smashed when the world's doing quite fine, and you can allocate money to Thailand or India or Europe.
So this fits perfectly within the backtest of the 4-quadrant model. When we went bullish on the US dollar in April of last year, and that's when the world was entering Quad 4 outright. Quad 4 in Europe, Quad 4 in EM, Quad 4 in China. So to your point, the reason why the world's reserve currency, even though crypto experts and everybody else don't like that it's the world reserve currency, unfortunately, it still is. And that flow trade is what gets you paid initially. Because you have to get the heck out of everything you were speculating on in EM, Europe, et cetera. So that Quad 4 is where the dollar bull gets paid. That backtest plays out, I could show you the expected value of the dollar by the 4 quadrants. The number one is there. Actually, the dollar doesn't have a higher expected value, even close, than when the world's in Quad 4. Growth and inflation are slowing globally. So that's really the catalyst for the dollar. And once the US joins that's the beginning of the end of the topping process of the dollar. So what I'm concerned about here is, which I've started to talk about the topping process of a US dollar, what that means in quad speak is that we're going from Quad 4 to Quad 3. The dollar's expected value falls in Quad 3, primarily because now the Fed is in a competitive currency war to try to devalue.
But then aren't you making the assumption that Quad 3 is a permanent change as opposed to a temporary phase before, let's say, more of Quad 4? Because this often goes, in your terminology, Quad 4, Quad 3, Quad 4. If you've got a full recession.
Exactly.
If you haven't, you're Quad 4, Quad 3, then I guess Quad 2.
Yeah, what the most important thing is that when you go from one quad to the next quad, you have, and positioning is on one side, in this case, net long dollar, you have a quick move to the downside that I'm not willing to bear.
Yeah.
I mean, if we were talking 6 months ago, or really throughout Q2, Q3, and Q4 of 18, I'd be like, my number one position wasn't treasuries, it was dollars. Because we were still hawkish on growth accelerating.
Yeah.
But I'm concerned, maybe overly concerned, about this transition to Fed rate cuts and the dollar's topping process that happens anyway, even if we only tip into Quad 3 for a 3 to 6 month period. But that's how I'm dealing with. The currency market is starting to get far more confusing than it has been. There's been breakouts in the Swiss franc against the dollar, there's a breakout in the Japanese yen against the dollar on my quantitative signal. And those are quite interesting as well. I mean, those there's a big breakout in gold, which I'm very bullish on gold for the first time in a while. And those things are not telling me that the world ends in rainbows and puppy dogs. That's down interest rates. That's what that's telling you. And potentially down dollar for some period of time too.
Yeah, it's not consistent yet, the dollar with the macro picture.
Right.
It's interesting because I've noticed the same thing. I'm thinking how far and sharp can the dollar correction be if it is a correction? Or is it this topping process? I don't think it is, but there's certainly a reasonable probability.
What you'll see is dollar, there'll be Quad 4 days for the dollar where the dollar's awesome. And if the market starts to trade on cowbell, those are not good dollar days. So I'm okay with that. I mean, that's
fine, but it's just not an easy bet. What's relatively easy is fixed income.
And
the cowbell days all work in your favor.
Right. Now, the gold trade becomes easy if the dollar trade becomes easier on the negative side.
Correct. But if not, it's a fight.
Yeah, that's a knife fight. It actually is just the inverse of what's going on in the dollar. But I mean, if you backtest gold all the way back, the biggest call you got to make for gold bulls is a negative call on real yields. And we're coming off the highs, the cycle high on real yields, and I think gold's figured that out.
Yeah. And so you've got a bunch of analysts who are also looking at sector stuff and across the board.
Yep.
What are they picking up that maybe the market's not seeing yet?
Well, they know what Quad 4 is now.
So are you having to teach them the macro?
It depends on the age of the analyst. If it's your first cycle, Raoul, you might learn something new in a very violent way. You know, we all do as analysts.
Yeah.
And then we have the older guys on the team that have been with me since we started the firm. Not their first rodeo, and they understand it quite well.
Yeah.
So if you take something cyclical like lodging, like our gaming, lodging, and leisure analysts, I mean, there's no way on this side of the sun that he's going to not be short hotel stocks at this stage of the RevPAR cycle, given the Quad 4 to Quad 3 the lateness of the business cycle is crystal clear.
Yeah.
I actually think for our analysts, the biggest risk is that the companies they like, because they're good companies, are going to meet their maker called the rate of change of earnings slowing.
Yeah.
So in as much as I always talk about the rate of change of growth and inflation slowing, the third leg of the stool for any analyst, and it takes me all the way back to where I started, was the rate of change of revenues and profits. And that, we're about to hit the toughest comparisons on a 1 and a 2 year basis for the S&P 500 earnings, rate of change, going all the way back to 2000. And the S&P 500 got body bagged when, year-over-year earnings growth went from 21% to basically flat. Here you got to come from 26%, which is the new high. And that comparison's all the way out into Q3. So this is the thing that I think a bottom-up analyst team is going to be really helpful in trying to help you contextualize the timing when it comes to both equity multiple compression and credit spread breakouts. Because really, Quad 3, the easiest thing to do in Quad 3 is to be short credit. Because they have an opinion on the forward-looking cash flow outlook. So we could have you could have just a run-of-the-mill slowdown in corporate profits, or you can have a disaster. I don't know what, it's not, I think, if I tell you what I think could happen, then I get into trouble. It's just stay with what the data's doing. It's trivial. Every day you're going to see the rate of change of earnings growth, every single earnings quarter. And it could be nasty or it could be benign.
And credit's the thing I've been watching very, very closely now as well, because there's a whole other bunch of setups within that, like General Electric being downgraded to junk.
Yeah.
That's a shit show for the whole junk bond market, because what you can do is tip out all the most illiquid junk bond credits to make way for it. And then we've got Ford and General Motors within that. And somewhere down the track, I'm very nervous about AT&T. So you've got this enormous amount of debt that I'm slightly worried about. If I look at the credit market, the credit market just doesn't feel good. It's the point in the cycle where it, as you said, that it follows corporate earnings, the business cycle, the whole lot tend to go at the same time. So I think it's an interesting...
It's an interesting thing. Like I go today's door to door with institutional clients, like especially those that think that interest rates, treasuries are shorts and interest rates are going higher. Ask them about the size of the corporate credit market. If you thought treasury issuance was a big supply problem, you can't say both things and come up with the same answer.
No.
I mean, literally, there's a pretty simple X and Y axis that I could show you, the volatility of the bond market versus credit spreads. And that we are in the very first to second inning of that.
Yeah.
And the size, I calibrate the size of corporate credit relative to GDP across every other year in the history of credit. And it's the biggest dot in terms of size. So we have the most credit relative to GDP, and we're at the most complacent point, whether you're looking at bond market volatility, move index, for example, or credit spread risk. 400 over on high yield OAS could be 500, 600, 800 wide.
Yeah.
And I think that's the moment where, when the Fed's providing cowbell and people see that, they look around and they...
And that's exactly my view. And I come at it from a different angle. I'm a business cycle analyst. I look at it in terms of the probability of where we are in the cycle and how long the cycle lasts, because it goes up and down.
Yep.
You just don't know how big the peak and trough is and the distance.
Yep.
But you kind of know, once it starts, it usually keeps playing through.
What side you're on. Yeah.
And so you look at the probabilities of that, and credit is that thing. And I just, as you say, I don't think anybody is really understanding what could happen within this credit market and the knock-on effects of everything else.
Nobody knows. There's not one person that can tell you the pace of a credit event and how it's going to work out with some linear model. What I can tell you is that a lot of people run credit levered long only funds.
Yeah.
And it's the,
And as you know, the door into a position is much bigger than the door coming out of position.
Again, I was at Carlisle when we literally, and actually the one that traded publicly in the UK, it's very well documented.
Yeah.
You know, bagel. I mean, if you are a pro-cyclical buyer of credit at the very beginning of the end of the credit cycle, disaster. In as much as you're a genius if you're the first buyer of distress at the right time, like Howard Marks' recent book, Mastering Market Cycles, I think it's called. He started in 1988. I mean, he tells you, and we should all be very humble about this very basic fact, it's where you start in the game that matters.
Always, right?
Yeah.
So here's a question for you, something I've been thinking through, is you're very process-driven. You're talking about, and we've talked about a little about algorithms and basically applying some sort of AI to the process, because if it's replicatable, you can get a machine to do a lot of it. There's some element maybe use of discretion, but then what was fascinating, you were talking about hotels. So here's a thing that I found out recently, is companies like Two Sigma are pinging hotel websites up to 1 million times a day.
Oh, yeah.
Everywhere around the world, using both the kind of conglomeration sites and the individual sites, so they can check real time, because when you ping a website and ask for a price, it moves the price up and down. It's basically market making. So you can tell, because if you know roughly what the algorithm is at their end, you can tell the occupancy rates of the hotels. So you can tell anywhere, real time in the world, in any city, what the total occupancy is like. So you have a real time economic indicator.
Yes.
It makes it very difficult to be a hotel analyst.
Yeah, no, I mean,
because the same thing that you're talking about in macro, you can actually see the data in real time.
So if you look, like we've talked about macro, but if you go back to my first job, which is being Mr. Fundamental Captain Stock Picker guy, and I have to have a view on my sector and my stocks. That is the research room that I've built. Like I have 40 analysts on the team. Only 6 of us do macro.
Yeah.
The other group, every day, month, quarter, they are gravitating to more, we call them DCTs, data collection tools.
Right.
To things that are smarter than they'll ever be, and by the way, a lot faster.
Yeah.
So this is like sitting beside me. I'm not going to name his name, but he doesn't even know. I wouldn't say he doesn't know what the companies do, but he's never going to pick a stock in his life. He's a data scientist. He sits there all day long and bangs code. Okay, that's who sits beside me, and we don't talk. There's no discussion. There's nothing to talk about. That's what he's doing, and there's going to be legions of those people. They're going to augment people like me and people like you and what they do if they do have data at the core of their process.
Fascinating. So here's an interesting one. So JP Morgan, from what I've heard, have this same data collection business based on every one of their bank accounts. So in real time, they can see use of credit cards, cash transactions, all transactions in real time. So they basically have probably the best real-time read on the US economy. I mean, it makes the Federal Reserve, all of that, nonsense. All of the agencies...
They should start a real prop desk with that again.
Yeah, maybe they should. But it's extraordinary, the power of data that they have versus what the Federal Reserve are even using. Okay, it makes a mockery of how our current system is constructed almost.
Oh, boy. I mean, don't get me started on that. The first time I presented at the New York Federal Reserve, I couldn't make this up if I tried. But I was showing a series, like I always do, a series of rate of change charts. And one of the Federal Reserve analysts got really into this one data series that I was showing in rate of change terms. He said, "Where did you get this data?" I said, "Dude, it's your data. Like, it's Federal Reserve produced data." The guy didn't know. The rate of change, it's just having rate of change at the core of your process. This might sound like the most basic thing. And in some cases, it actually insults your traditional economists. It can't be that easy. It can't be base effects plus rate of change. I would have thought of that. And that's how they think. Using a stochastic model like we use, Bayesian process, it's data driven. Every data point should change your opinion. Versus a deterministic model that the Fed uses or some regression. I mean, it doesn't work. I mean, it's like you don't want them to figure it out though. How else would you make money?
Yeah.
I mean, you have to have that institutional established, or the establishment has to have these views and these, effectively useless processes in terms of being actually accurate. You have to be able to play. I want them to be gainfully employed as long as possible.
So your analysts are picking up what other surprises? What else fits in with your macro view that they're picking up that the market's not seeing? Because some of these are more obvious now to people. They're starting to see the slowdown
Yep.
in housing, cars, bits and pieces. Is there anywhere where your guys are saying, hey, listen, here's something new here that people aren't figuring it out?
In healthcare, there's a tremendous amount going on. So like the pricing disconnects in healthcare, some healthcare deflation that's non-obvious, that is becoming more obvious at the company level. So if you're building data collection tools that is looking for specific things within healthcare, you're going to find a lot of new and interesting things. Healthcare is ripe for this because there's so much publicly available data.
Yeah.
I think that's another thing that a lot of people, they're fascinated with big data, but there's so much data that's useless. I mean, there's certain data that's absolutely critical. So I think that's probably where we're doing the most amount of our work and committing the most of our resources, because it does take, takes you still need humans to run Python.
Yeah.
There's a tremendous amount of data they can grab and show you. And I'm telling you, like, you take a Python analyst, our data scientist, you put him beside a very well compensated, 10 years in buy-side type hedge fund analyst, who I'd like to think is who's my analyst in this case in healthcare, and his boss has been doing it for 25 years. Healthcare PM. We actually used to work together at Dawson. But this guy, the data scientist, will blow their mind routinely. I watch. It's like everything that it's almost like they have these moments. So there's so many different answers to that question. It's what they thought their whole career in some cases just isn't true, or it's not useful at all.
So talk to me about this, because this is a recurrent theme. You're on Twitter, you'll be talking about old wall.
I've never met. What is that?
What do you mean by that? Because clearly you're doing something that's very, for a research firm, it's not common what you're doing, which is blending, process-driven macro fundamentals plus data science, and this is a new world.
Yep.
Talk me through the old world as you see it, and what this old wall is to you.
Well, old wall it's an easy metaphor because people can grab onto it. It's like Mac versus PC.
Yeah.
One's cool, one's not. One works, one doesn't. Eventually PC has to fix what they were doing, and maybe now it works better. But in the beginning, just go back to what you used to do and just criticize it objectively. What I used to do doesn't work. Or if I was doing it and I was really at the top of my game, Captain Stockpicker's really killing it, gets lucky on some of the macro, it's not what you want to be. The old wall is a metaphor for broken, established best practices that people thought made things go up and down. A lot of people start their day saying, well, this stock's cheap, it should go up. This one's expensive, it should go down. That is it's actually a borderline asinine assumption, but it's an old wall one. Mm-hmm. There was a day when if you talked about valuation, it would make you sound reasonably intelligent. Pre the internet, for sure. I mean, now I got 4 kids. I'd say at least my 5-year-old could tell you what the PE is on any stock if I give them the letters.
Yeah.
That's got no value. I mean, so valuation is not a catalyst. The rates of change of growth and inflation are. They drive multiples up, they drive them down. So when I talk about the old wall, I talk about it in 2 different ways. I think of old wall analytics and how you're coming to your conclusions, where strategists are, where sell-side analysts are. This is the epicenter of brokenness. And not to mention there.
Many have, if you go to the asset management industry, plenty of people are using asset allocation models that are not a million miles from what you're doing.
No. I mean, from what I understand, without him slapping his predictive tracking algos and outcomes right on my desktop, I mean, Bridgewater has sufficiently conquered the world in asset allocation space.
Mm-hmm.
They don't nail it every time, but they're certainly better than some dude at an RIA who doesn't have any computer or any view, but he's like 60-40 stocks versus bonds. That's old wall. Okay?
Yeah.
Old wall, I was going to say the other piece is actually that piece. That's what I'm like, now it blows my mind. How many people in the world think that Wall Street is a regurgitation of people that are on TV? They're basically regurgitating the calls of the day from the old wall itself. I mean, old wall media is actually far worse than the old wall. At least the old wall has a spreadsheet. Might not be the right way to do it anymore. But imagine the journalists and the reform whatevers are out there, brokers and whatnot, they're telling you what your asset allocation should be. That to me, that's a phenomenal opportunity. Is just to educate people that you just don't do that. Please don't do that. And the Treasury call this year is a great example of that. How many people that should have been allocating to that massive Asset allocation should always be part of what they're doing at certain points in their life. I mean, it was the best time that you're going to have in a long time.
Yeah, I agree. I just think the whole way the financial media set up, and again, in the financial media, I'm not talking about the FT and the Economist and stuff, because that's different. But really, I'm talking about television media. Is, one of the reasons we started this was because how shit it is. It's just 3-minute sound bites.
Yeah.
What are you going to get out of it? They're going to get Keith on there for 3 minutes saying what? I think treasuries are going up. Okay, great. Where's the value in that?
Yeah.
That's an opinion.
Absolutely.
Right? People will now sit and say, oh, Keith has an opinion, it's based on this. From a Real Vision interview, they'll know very clearly what your opinion is based on. It's, there has to be some respect for people's money and not just throwing them an idea and saying, well, this is what it's all about as a sensationalist headline. It just doesn't make sense.
Yeah, it's the old adage, you teach a man to fish or you just give him one. I mean, the education process is the opportunity in the media, because to your point, people are asking people on TV for their picks. They're not asking them for their process. You're going to come up with the dumbest quotient that you could possibly find to interrogate you, talk over you, give you absolutely no time at all to your process. Do you think Joe Kernan knows anything about my process? He knows where the Dow is in points.
And how many points it's gone up every day and every point it goes down, which is the most ludicrous, useless thing ever.
That's old wall. That is the old wall.
That really is the most fundamental thing. When somebody goes, the Dow is down 1,000 points, it is the most meaningless thing you can say. It drives me utterly to despair.
Yeah, it's interesting. In one of the better books that was written last year, I think, practitioners get it. People that have made a lot of money in markets and have had good processes and great track records. Ed Thorpe's book, I don't know if you read it.
Yeah.
If you could get him,
we've been trying to get him. So
the book's called A Man for All Markets.
Yeah.
Because he wrote Beat the Dealer, then it's Beat the Market. He was one of the original quants.
That's right.
He's a math genius from California, or at least that's where he had his job before he decided to take on the real stuff. I mean, this guy starts his book by actually saying exactly what you said. He's like, it's a joke. Like, when you're driving down the road and somebody tells you that the market's down a lot, 400 points, and it has no perspective on percentage moves or anything, that you should just turn it off and listen to some good music. I mean, it's actually kind of funny that this is still a debate as to why people watch that stuff. I guess they don't have an alternative.
No. And this is what it appealed to me, because I've been following you for a while. What appealed to me, what you were doing, is you were doing similar things in a different area to us. You were just saying, listen, whatever's going on over here that used to go on, there's something deeply wrong with that, and there is a different way, and we're going to try and show you the different way, and we won't be right all the time. We'll do our best to guide people. And we did the same thing. We said, look, something over here is deeply wrong. We're going to try our best. We have no idea. We've never been a media company before, but we're going to try and do this.
Yeah.
And I just always thought there was some kindred element of understanding, okay, the world has changed and people deserve better. And because in the end, we're dealing with people's life savings. And I keep saying that to people. And when I tell people that who are in the old school media business, or even in the asset management business, they don't really understand that. But when you get a bit closer to the end client, which you do and I do, you kind of know how important it is to the doctor in Ohio who spent his whole life busting his balls to do this. And you take a fiduciary responsibility for the kind of information you give him. But everyone else seems to have lost that responsibility.
It's easy to lose touch of what you don't touch. I mean, we touch real people every day. I tweet with real people every day. I don't care what they make or how smart they're supposed to be. Or you engage with your audience and you'll start to feel like what they really want. And what they really want is that education. They know it's broken. They've just never had somebody come out and say, hey, look, I hear you, and I'm going to try to create products and services that can help what it is that you want to help yourself. My dad's a firefighter, retired firefighter. I get it. Like, you're not allowed in his world to work your whole life, 38 years in the fire department, and lose 40% of it at a time twice, if you were lucky, being fully allocated to stocks at the top. No, you can't do that to people. How many people do hedge fund managers, mutual fund managers individuals touch in the market during the real market day? Zero. You're not allowed to.
No.
So just think about that. I mean, there's a different forum to translate your knowledge and your process, and it's media. And that's to me, it's actually the reason why I've never gone back to running money. You know, a basic question people will always ask, well, if you're good at this, why don't you just go run money? It's like, that's so boring compared to this. You and I wake up in the morning, correct me if I'm wrong, but we actually believe that we can change the world.
Yeah, it's true.
That we don't have conflicts of interest,
And we're not
compromised.
And it's not hubris. We're actually trying to do something.
Yes.
We're actually trying to do something good for as many people as we possibly can. And that's a good thing. Keith, brilliant to meet you. Finally get you here. We'll have to get you back a few times, and we'll get a few other Hedgeye people on, because I think it'll be super interesting.
Yeah, well, thanks for having me. It's a great conversation. It felt like it was only 10 minutes long.
Yeah, I know.
Yeah.
I know. Well, we'll get you back soon.
I appreciate it. Thanks.